Hello, this is Birken Road Report's continuing coverage of AMERISAFE Incorporated, Spring 2011. As of April 18, 2010, AMERISAFE stock was trading at $21.91. The 52-week range was $15.50 to $23.72, with 18.2 million shares outstanding and a market cap of $398 million. As indicated by the 6-month growth chart, AMERISAFE stock was shown an upward trend since February of this year, with a strong increase in price following the 2010 annual report release. AMERISAFE is a specialty provider of workers' compensation insurance. The company focuses on small to mid-sized employers in hazardous industries. The company began in 1986 by providing workers' compensation coverage to employers in the logging industry. Now AMERISAFE has grown to focus on a wide range of hazardous occupations and actively markets insurance in 33 states. AMERISAFE has demonstrated expertise in underwriting the complex workers' compensation exposures inherent in the construction, trucking, agriculture, logging and wood products, oil and gas, maritime, aggregates, and the manufacturing industries. The company's first strategy focuses on increasing underwriting profitability throughout market cycles. The company strives to maintain competitive rate levels for low-frequency claims, a goal that can be achieved with proper risk selection and intensive workplace safety reviews. The second strategy is to increase market penetration. Sufficient room exists for increasing market penetration because AMERISAFE does not have substantial market share in any of the states in which it operates. Geographic expansion is a key strategy that AMERISAFE is well positioned for. The company is licensed to provide insurance in 47 states, the District of Columbia, and the U.S. Virgin Islands. The company only markets insurance in 30 states and the District of Columbia, and 54.4% of its premiums were generated from just 7 states. AMERISAFE intends to expand into these remaining territories and views the additional licenses as a means to expedite this expansion. Information technology plays an important role in keeping the company's business efficient and profitable. AMERISAFE has a reliable and function-rich underwriting system that includes a customized operational system called iCAMS that feeds the company's analytical data warehouse. iCAMS enables the company to effectively analyze and select risk. Maintaining capital strength is a major strategy for profitability. AMERISAFE plans to maintain profitability with optimal operating leverage through various techniques. The company intends to accomplish this strategy by maintaining underwriting during all market cycles, effectively managing reinsurance, and producing appropriate returns on its investment portfolio.
The workers' compensation industry outlook remains difficult and competitive. Prior to fourth quarter 2010, AMERISAFE experienced 7 straight quarters of premium decline. The fourth quarter 2010 report announced a 5.6% increase in premiums despite increasing pricing late in the third quarter 2010. Despite uncertain economic conditions, AMERISAFE has been able to increase earnings throughout 2010. High unemployment rates have affected multiple industries for which AMERISAFE writes premiums. This adversely affects net premiums written by the company. Writing premiums is the primary source of operational revenue for the company. Therefore, premiums written greatly affects cash flow. However, although revenues declined in 2010, AMERISAFE was able to maintain a strong balance sheet by continuing to follow its underwriting standards. During 2010, AMERISAFE increased its investments by 3% to $826 million. AMERISAFE's investment strategy is primarily risk-adverse. Among the held investments are municipal bonds, corporate bonds, and U.S. Treasuries. However, the majority of the investment portfolio comprises fixed maturity securities. These fixed maturity securities are held to maturity, and as of September 30th, 2010, the fixed maturity securities have an average composite credit rating of AA. Through 2010, the company's portfolio has remained risk-adverse and stable. We value AMERISAFE's 12-month target stock price at $25.95. We considered 5 models to forecast the 12-month stock price: the ratio of price to book value, discounted cash flows, the PEG method, enterprise value to EBITDA, and price to earnings per share. Because of the nature of an insurance company, we decided to only use the price-to-book value ratio. The price-to-book value ratio is a measure of the company's book value relative to its stock's current trading price. The price-to-book value multiple is 1.24 times in AMERISAFE's case. AMERISAFE's 12-month estimate target price is $25.95. We use this aspect of the relative multiple method rather than price to earnings per share because price-to-book value is the most popular multiple used to value insurance companies. This is because earnings are not completely correlated with an insurance company's performance and they interfere with the valuation. The price-to-book value better represents the large percentage of investments on the company's balance sheet. This method most efficiently values the company by taking the real value of the investment assets and small fixed assets less the company's liabilities. The Birkenroad reports are produced solely as a part of an educational program of Tulane University's A.B. Freeman School of Business. The videos are not investment advice and you should not and may not rely on them in any making investment decision. You should consult an investment professional and/or conduct your own primary research regarding any potential investment.